Continuing our discussion on stock valuation, let's look at some alternative techniques, if you will, of what we can do to find the value of stocks. Frequently, there are companies that don't follow the strict guidelines of the dividend model. If you remember, the dividend model requires or assumes a constant growth rate, but there are companies that, due to innovation, etc., have a varying growth rate through time. Sometimes these are your textbook, and many textbooks refer to these as differential growth rates or variable growth rates. I think a very self-defining title is supernormal growth rates. And this model that I have is a very simple model. It assumes one change, that a company has a new innovation. The growth rate grows at above normal industry rate, in this case 12%, for a certain period of time, 4 years here. And that at the end of that time period, because competition is going to take place, other companies are going to find products that are very similar to the ones that you've invented. So economics is going to take place. Supply and demand is going to reduce prices and increase costs of raw materials. So it's going to ultimately go back to the industry standard. This company's most recent dividend was $4.25, and the required return for the stock is 20%. So what is the value of this company's stock? Again, we're going to use something called the supernormal stock valuation worksheet. And again, very simply, you plug the numbers in that you know: 425, 9% for the growth rate, 12% for the supernormal growth rate. Supernormal growth rate periods 4%, 20% required return. And you can see here the total value of this company. The stock's price is worth roughly $46.31. Where does this price come from? Well, the first number here, the $14.35, comes from the present value of the growth of the next 4 dividends. So we find out, we know what the growth rate is. We calculate dividends 1, 2, 3, 4, and we find their present value. In addition, this model says, wait a minute, at the end of year 4, we need to know what's the price moving forward to infinity of this stock. And now we're going to use the standard growth rate of 9%. So now we just revert back to the more normal dividend growth model formula. So it says that future price is worth $31.97 or 96 cents, and that's obviously the present value, I'm sorry. And you add those together, we end up with $46.31 is what this stock is worth. Again, we can use, if you're good at programming, you can put in alternate growth rates so the growth decreases more gradually over time. You can do whatever you want to alter the spreadsheet, but this very basic model shows the idea or the concept that we don't necessarily have to have a strict adherence to the constant growth model. So what are the limits of these dividend growth models? There's a lot of time spent calculating and forecasting dividend growth rate and future dividends. And this is very difficult. It's very uncertain what the outcomes of those things are. And for some stocks, changing this growth rate can have a great impact on the answer, right? It can really influence the value of this company's stock. So we do understand that there are some limits to the model. Another way of addressing this payout model or getting money to shareholders is what's referred to as total payout. If you think about how shareholders get money from the company, there are really 2 ways that they get that return. They could receive dividends, or the company could repurchase stock. so that when the company buys back stock from shareholders, those shareholders get a cash flow payout. Now, of course, those shares are no longer owned by the public. So if those were your only shares that you had in your portfolio, you're now no longer an owner of that company. So, I mean, there are some different types of ways to look at what's really going on here, but we want to just concentrate on one. This is a cash distribution. What happens if a company decides not to pay dividends, but instead it wants to give money back to its shareholders by repurchasing shares? Or maybe they do this in combination. Maybe there's a strategy of combining these two strategies. We want to understand how this concept works. What is happening here? Well, this particular model, we want to find now the present value of all the total dividends and stock repurchases for the year. So now we're going to look at the firm's equity rather than just a single share, right? So we're going to look at total dividends and share repurchases. We're going to use a growth rate of earnings rather than the earnings per share number. And then we're going to obviously forecast on the growth of the firm's total payouts. So gathering this information from Disney, the weighted average cost of capital is a required return, the cost of financing for the company. Now, I will tell you that this number in the last couple of years has become a little bit more difficult to find the actual number. So there was a site for a while that you could go to that would produce or calculate the weighted average cost of capital for a company. That site has, at least for the last year or so, has now kind of disappeared and doesn't provide answers anymore. So we need to understand that sometimes it's difficult to go out and actually find these numbers, if you will. So from time to time, you can go out and find, if you go out and Google, for instance, Disney. If you Google Disney WACC, what I found out here when I go out here and look at this, there actually is the weighted average cost of capital is 9.5%, as listed by one website. So again, the actual number that you get, could vary from time to time, but we also want to make sure, maybe we use a couple of sites if we can find a couple of different places to go. Again, it's not the easiest number to find. We'll try to calculate this maybe in a later chapter. But anyhow, we know the number of shares, dividends paid. In this case, it's the estimated earnings per share growth we're using is 4%. And again, the numbers here that were in the original data were somewhat unrealistic. So again, there are some numbers. We can kind of get rid of this thing because it has been changed, so we don't have to worry about that. So the numbers here reflect some changes that I made basically because of some unrealistic types of growth that they were talking about. But in the end, it says that the value of this stock using the total payout model worksheet is roughly $118.55. We just input the data that you have and you get an answer, right? So if we look at this company's stock from previous examples, we know this stock was selling for roughly around $110. So this says that the current stock is undervalued based on this strategy of total payout. So let's see if we can look at this a little bit differently, right? Another way of looking at this. A company expects to have $125 million in earnings, and they're expected to grow at 6%. They don't pay dividends, but they want to use 25% of its earnings as stock repurchases. Cost of equity 15%, and it has 25 million shares outstanding. What would the stock price of this company be? Again, plugging the information that they provide us, we know what? That the stock repurchases, it's going to be 31.25 million. Of course, there's no dividends paid out, right? So we don't have that number. The weighted average cost of capital is 15%. Number of shares they have is 25 million. Growth rate of that 6. So this company would have a value of roughly $13.89. Again, there's a lot of different ways that we can use, a lot of different tools, ways to look at things. So another way to look at this company, or a company, would be to look at its free cash flows. So let's think about some definitions and terminology before we get right down to the nitty-gritty here. The free cash flow of a company, right, is based on a concept that's referred to as enterprise value. So we want to find the value of the firm to all investors, including both debt and equity holders. So the enterprise value can be interpreted as the net cost of acquiring the company's stock, taking its cash for part of this purchase, and then paying off all the debt. The outcome is a company that has zero debt. So you have an all equity company when you have completed. Free cash flow, the definition is, it is the income of the company, the cash flow, EBIT times 1 minus T, unlevered net income plus depreciation. Then we subtract out any capital expenditures and any increases in net working capital. So what free cash flow leaves us is the cash flow that's available to pay all of our investors, which are our debt holders and our equity holders. So the discounted free cash flow model is based on the value of the present value of the future free cash flows. To find the actual price per stock, we would need to divide this, again, by the ultimate thing, the value, add the cash, subtract out the debt, and divide that by the number of shares. So let's see how this breaks down if we do a little algebra. Based on the concepts of the dividend model, if we assume infinity, and if we assume a constant growth rate, in this case, not a growth rate of dividends, but a growth rate of free cash flow, we can then calculate or have a formula that looks very similar to our dividend discount model. In case here, we have what? This is the free cash flow plus 1. We have, instead of the cost of equity for the stock, now we have the weighted average cost of capital. If you remember, this is what we're going to talk about in chapter 12. It's the cost of financing, and then the growth rate. So again, we have a very similar model, formula, if you will, from the dividend model. So the value of a company, what we're calculating here, is the value of the stock plus the value of the debt minus its cash. So to find the value of the stock, find the value of equity, you take the value of the company, subtract debt, add cash. This is we're just doing some algebra with the enterprise value formula. So let's look at this company. We've estimated free cash flow to be 7%. The most recent was $700,000, and the company has a weighted average cost of capital of 13%. So the company's value is $12.48 million. The company has $1 million in cash, has $7.5 million in debt, and they have 100,000 shares. So what's the value of equity? So the formula, you take the value of the company, $12.48 million, minus $7.5 million, minus or plus the $1 million, we'll end up with a value of the company of of the equity of the company, excuse me, of 5.98 million. Divide that by the 100,000 shares, and that will give us an estimate of the value of the company. So here we have plugging that stuff into what's referred to as the free cash flow valuation model for stocks. We end up with, divide that by 100,000, this stock is roughly worth $59.83. Now we can apply that to Disney. Here's Disney's data that I gathered throughout from Yahoo Finance. And what we can find is we can plug in the numbers into the worksheet just as we did with the dividend valuation model. At the top here, we have the weighted average cost of capital, 9.05, growth rate 4%. So the value of the company based on the free cash flow model is $191 per share. Again, a substantial amount of value for the firm. Now we need to subtract out the value of debt, any of the cash that's available. So now the market value of the equity of the company is 167. Divide that by the number of shares. We find out that the free cash flow model says that the value of this stock is roughly $107.08. So this model is particularly interesting since it really has a direct connection to capital budgeting. Free cash flow is the sum of all the free cash flows that we've acquired to date, right? The current firm's free cash flow that it's acquired, plus the free cash flow of any future investments that they're looking at. So again, this total net present value of the company is an accumulation of what we've done to date and what we think we're going to do moving forward. So the net present value of any individual asset is a contribution to the firm's enterprise value. So to maximize share price, we should only do projects that have positive net present values. So these three different techniques all address different parts of valuation. The dividend model looks at the stock price. The total payout model looks at equity value. The free cash flow model looks at enterprise value. So they all look at valuation from a different perspective for the company. So now let's change gears to another methodology. This is what's referred to as a method of comparables. Finding companies. Sorry about this. I have something going on weird with my PowerPoint. Keeps wanting to click out on me. So we have this valuation model that's based on something referred to as comparables, right? So we have a valuation multiple. It's a ratio of the firm's value to some measure of the firm's scale or cash flow. So we're really looking at a relationship between two values that have something to do with price. So let's look at the basic model we can look at is something referred to as the PE ratio. We've talked about this ratio before, and we know that this is just the share price divided by the earnings per share. So is there a link? Well, since price is in the formula, there's obviously a link. So what are the variables that are available to us? We can look at what's referred to as trailing earnings. These are earnings over the last 12 months. Or we can also look at forward earnings. We can predict what we think earnings are going to be over the next 12 months. We can look at a trailing PE ratio, or we can look at a forward PE ratio. In fact, we can even substitute for the forward PE ratio. We can even talk about industry PE ratios. So here's a company, right, that says it has earnings per share of $1.38, and the average PE ratio of companies in its industry is 21.3. What is the value, or what value can you attribute to this company? $29.39. Now, of course, we can plug anything in here we want. We could put in the company's current PE ratio and estimated earnings per share. We could put in company's estimated PE ratio, its forward PE ratio. In this case, we used its industry ratio number. But all of these numbers can help us predict value. So what does it do, or how would we use this for Disney? Disney's PE ratio forward is 15.48%. We got that from Yahoo Finance. Its earnings per share next year, $5.94. So we're predicting, based on the PE multiplier model, that Disney is worth roughly $91.95 at the end of this year. Is that, if the current stock price is $110, that sounds like maybe Disney is not the best purchase that we could make for our investment dollar. We can also look at enterprise value. There's an enterprise value multiplier. You take the enterprise value and you divide it by EBITDA. This valuation multiple is really nice if you kind of think about looking at growth companies. If this number is high, or we assume or we say that we think the number's high, we are implying that this company has high growth rates and low capital requirements. So in this case, free cash flow is high relative to the proportion of its EBITDA. So how can we plug this into our Disney model? From Yahoo Finance, there is an EV multiplier, 12.12. EBITDA for the company, 17.1. Debt, 27.8. Cash, 3.86. Shares, 1.56. Using the stock valuation comparable spreadsheet, we find out that EBITDA, this EBITDA value multiplier, says that this company's stock is $117. But you can buy the stock for $110. So this model is saying that it thinks that the Disney stock is actually undervalued. What about other multipliers? Price to sales. Again, we have the company's price to sales ratio came from Yahoo Finance. Estimated sales, Yahoo Finance. Number of shares, we got that from Yahoo Finance. So this is saying that the value of the stock, using this multiplier, $113.38. Again, you can plug this data in for a company, and it very quickly gives you an estimate of what the value of the company should be. And by the way, this is saying this is the value 1 year from now, right? Because it's based on estimates. All of this data is typically available in Yahoo Finance. So it gives you fairly ready access to information. What are the limitations of these multipliers? Well, there's no real clear theory that connects all of these things, right? What about when companies have differing growth rates, or they change their growth rate in between calculations? Or what if a company changes its accounting policies, right? Comparables only provide information relative to other companies in its comparison set, right? So when this should be using, not suing, sorry. When using industry data, right, using multipliers typically will not help us determine if an entire industry is overvalued, right? It's really looking at a company. So using industry data probably isn't the best data to use when you're applying it to a company. So that's the end of this video. We have another video coming up, part 3.